Today, we're setting the scene. We're going to unpack a complex and often controversial mortgage strategy step by step, with real numbers, clear pros and cons, and a straight-up verdict on whether it actually works. First, what is this strategy and why should you care? In broad terms, we're talking about mortgage acceleration techniques that use a combination of a home equity line of credit or offset account and aggressive cash flow management to pay off a primary mortgage years earlier than scheduled. It sounds attractive. Cut decades off your loan and save tens of thousands in interest. But it's complex, risky for some borrowers, and easy to misapply. So our objective is simple: give you a clear, practical breakdown so you can judge for yourself. Why this matters now. Interest rates have been volatile, housing prices varied, and many homeowners are rethinking long-term debt. A strategy that worked under low rates may falter when rates rise, and the math can be counterintuitive. We don't want myths or marketing slogans. We want transparent mechanics, concrete examples, and the real trade-offs. You'll get a walkthrough showing cash flows, how accounts interact, the role of variable rate credit, and worst-case scenarios where the plan breaks down. We'll use a single case study as our spine: a 30-year, $300,000 mortgage at 4.5% fixed, paired with a HELOC at 6% variable. We'll show month-by-month effects of redirecting salary into the HELOC, making lump sum reductions to the mortgage principal, and the resulting interest savings versus the baseline amortization. That's the real numbers part, not just percentages, but dollar figures and timelines, so you can see how many years you shave off and how much interest you actually save. Expect balanced analysis. We'll highlight where the strategy shines: disciplined cash flow management, potential tax benefits in some jurisdictions, and faster equity buildup, and where it falters: higher variable rate exposure, fees, and behavioral risk if you don't keep the discipline. We'll compare to alternatives like biweekly payments, extra principal payments directly to the mortgage, and refinancing. By the end of this segment, you'll understand the goal, the mechanism, and the stakes, and you'll be ready to follow the detailed step-by-step example that comes next. We're about to unpack a mortgage strategy that many find controversial: accelerated mortgage payoff using a biweekly payment plan plus periodic lump sum principal injections. First, what this strategy actually is. At its core, it combines two key concepts. 1. Converting monthly mortgage payments into biweekly payments, paying half the monthly amount every 2 weeks, so you make 26 half payments a year, effectively 13 full monthly payments instead of 12. 2. Committing to occasional extra principal payments or windfalls, tax refunds, bonuses, or savings to further reduce the loan balance. Together, the mechanics accelerate amortization, save interest over time, and shorten the loan term without formally refinancing. Why people use this approach? The primary goal is to reduce total interest paid and retire the mortgage faster while keeping the original low interest rate and terms. It appeals to homeowners who want discipline without changing loan paperwork, who expect intermittent cash infusions, and who prefer a blended saving repayment plan rather than a single big refinance. It's also used by those who can't qualify or don't want to refinance into a shorter-term loan but still want an aggressive payoff. Real numbers to illustrate. Imagine a $300,000 30-year fixed mortgage at 4% interest. Standard monthly payment is about $1,432. Biweekly half payments of $716 every 2 weeks yield 26 payments equals $18,616 yearly versus $17,184 with monthly payments. That extra $1,432 annually reduces principal and cuts the loan term by roughly 4 to 6 years, saving tens of thousands in interest, roughly $60,000 in one common projection. If you also direct a $5,000 annual bonus toward principal, savings accelerate further, potentially knocking off another few years and thousands more in interest. Supporting opinions. Many financial planners endorse the math. Extra principal reduces interest and shortens term. Critics note the modest nature of biweekly benefits compared to simply making one extra monthly payment a year, and warn about fees some lenders or third-party services charge to set up biweekly plans. Challenges and caveats. Ensure your lender applies payments immediately to principal rather than holding them in an account. Confirm no prepayment penalties. Weigh opportunity cost. Could extra cash earn more in investments or pay higher interest debt first? Also, behavioral risks. Some people overspend if not disciplined. Connection to broader mortgage decisions. This strategy intersects with refinancing choices, emergency fund planning, and tax considerations. It's a middle ground alternative to refinancing into a shorter-term loan. Less paperwork, lower cost, but also potentially smaller gains. The verdict on whether to use it depends on personal cash flow, interest rates elsewhere, and financial priorities. Now, we walk through a concrete, step-by-step example so listeners can see exactly how this strategy plays out in numbers. We'll use a controversial tactic, making extra biweekly payments on a 30-year fixed mortgage to accelerate payoff and reduce interest. Start with the facts. A $300,000 mortgage at 4.5% annual interest, 30-year term. The standard monthly payment is $1,520.06. Annual interest is calculated monthly by dividing 4.5% by 12. Step 1. Convert monthly to biweekly plan. The biweekly strategy splits the monthly payment into two equal payments of $760.03 every 2 weeks. Because there are 26 biweekly periods in a year, you end up paying the equivalent of 13 monthly payments instead of 12. Total annual outlay becomes $1,520.06 times 13 equals $19,760.78 versus $18,240.72 with standard monthly payments. That extra $1,520.06 goes directly toward principal over the year. Step 2. Compute first-year interest and principal with biweekly schedule. In the standard plan, the first-year interest is roughly $13,440 and principal paid about $3,840. With the biweekly extra payment, interest falls by about $1,000 in year 1 and principal increases correspondingly. Over the first year, your principal balance drops to roughly $295,400 instead of $296,160, a small but meaningful difference. Step 3. Project long-term effects. Using amortization math, that extra monthly equivalent payment shortens the loan by roughly 4 to 6 years depending on rounding and when payments are applied. For our example, the 30-year mortgage can be paid off in about 25 years, and total interest paid over the life of the loan falls from about $247,220 to roughly $206,900, a saving near $40,300. Step 4. Practical considerations and fees. If the servicer treats biweekly payments as partial payments and doesn't apply the extra immediately to principal, you may not get the benefit. Third-party biweekly services sometimes charge fees. Doing it yourself by making 13 monthly payments a year or scheduling extra principal payments avoids fees. Step 5. Shortcomings and alternatives. The strategy requires discipline and sufficient cash flow. The savings are meaningful but less dramatic than refinance strategies when rates drop. If prepayment penalties exist, it could backfire. Alternatively, making a fixed extra principal payment each month or increasing payments when possible yields similar benefits without scheduling complexity. Final verdict in numbers. For a typical borrower with no prepayment penalty and reliable cash flow, the biweekly 13-payment approach meaningfully reduces interest by about $40,000 on this $300,000 loan and cuts roughly 4 to 6 years off the term. It works, provided payments are applied properly and fees are avoided. We'll run side-by-side scenarios so you can see, in plain dollars and months, how a traditional mortgage stacks up against the controversial strategy. First, define the baseline. Traditional, a 30-year fixed mortgage, $300,000 principal, 4.5% annual interest, monthly payment about $1,520. Strategy, same loan size and rate, but you add a disciplined extra payment plan, either biweekly payments or a fixed $500 monthly extra toward principal. We'll show both strategy variants where helpful. Scenario A. Traditional. Borrow $300,000 at 4.5% for 30 years. Monthly payment, $1,520. Total paid over 30 years, roughly $547,200. Interest paid, about $247,200. You make the same payment every month, no extra principal, and you amortize fully in 360 payments. Scenario B. Biweekly payments strategy. Pay half the monthly amount every 2 weeks. Because there are 26 biweekly periods, you effectively make 13 monthly payments per year instead of 12. Same rate and starting balance. Result. Loan paid off in about 25 to 26 years instead of 30, depending on timing and exact day counts. Total interest reduced by roughly $30,000 to $35,000. Pros: faster payoff, lower lifetime interest, minimal behavior change if automated. Cons: some servicers don't apply biweekly payments immediately to principal and may treat them as prepayments held in a suspense account, negating benefits. Also, the interest saving is modest relative to refinancing or investing alternatives. Scenario C. $500 extra monthly principal strategy. Same loan, add $500 to each monthly payment, so monthly outflow $2,020. This directly reduces principal and shortens term to about 18 to 20 years. Total interest paid falls significantly, roughly $130,000 to $150,000 saved compared to the traditional path. Pros: large interest savings and accelerated equity build, psychologically rewarding. Cons: opportunity cost. That extra $500 could be invested elsewhere with higher expected returns, or used to pay down higher interest liabilities. Also, liquidity risk if emergency funds are insufficient. Relevant viewpoints. Financial planners emphasize comparing after-tax and investment return scenarios. Banks warn about prepayment penalties and account handling. Critics call biweekly plans a marketing gimmick if not handled correctly. Supporters highlight forced savings and simplification. Connection to broader mortgage decisions. These outcomes should be weighed against refinancing options, investing the differential, or keeping cash reserves. Verdict. Both strategy variants can work to reduce interest and term, but their effectiveness depends on loan terms, servicer practices, personal cash flow priorities, and investment alternatives. If your servicer applies payments promptly and you value a guaranteed return equal to your mortgage rate, the strategies are often worthwhile. If you can reliably earn higher after-tax returns elsewhere or face prepayment barriers, reevaluate.